thank you everyone for joining in another session of our fund manager series. And we have with us today Mr. Ankit Jain, who manage more than 70,000 crores across four mutual fund schemes with Mere Mutual Fund. He has more than 12 years of professional experience in the asset management industry. He's currently managing their multi-cap, mid-cap, consumer and large and mid-cap fund. Thank you, Ankit, for joining in with us today and addressing our audience.
Thanks for the invite.
Ankit, I want to start with a very basic question. We have very different categories of mutual funds. There are more than 4,000 mutual funds schemes in the country. There are more than 12 categories in just equity mutual funds. And if we just look at the three basic categories, large cap, mid cap, and small cap, how do we define these three categories for the benefit of our audience? Because they usually don't understand what is large cap, mid cap, small cap, and what size of the companies get usually classified as large cap, mid cap, and small cap.
So you're right. I mean, generally, if we look into as per the AMFI definition, right? I mean, top 100 companies classified as a large cap, top 100 in terms of market capitalization, right? So typically, some of the characteristics of these companies are maybe relatively, maybe market leader in their respective subsegments, might be catering to the bigger sort of sectors, which has got very large sort of addressable market, which comes maybe mainly in the financials, maybe IT, so oil and gas, maybe metals. So some of these sectors are like heavyweights. Within this, and are relatively larger the market cap companies. So if you look into the minimum market cap, 100 company in the large cap is, let's say, at around 85,000 crore. Then 101st start as the first starting point for the mid cap companies, which is like next 150 companies till 250th. 101 to 250th is classified as a mid cap. So these are like maybe let's say next to the larger companies when it comes to the bigger sectors, let's say financials and all. But then there are also presence of many leaders, market leaders in some of the smaller subsegments, right? I mean, some of the newer areas. Point in case you look into, let's say pharmaceutical sector, maybe might be having larger weightage in case of, let's say, mid cap mandate versus a large cap. Similarly, you look into, auto ancillary, auto basically ancillary companies will be having higher weightages. Then you look into real estate and so many other sort of sub-segments which are inherently have higher growth potential also, but sort of a part of the mid cap. So that starts at 80,000 crore market cap and ends at around 30,000 crore market cap, 250th company. Then 251st onwards is what the small cap, which are then again, the companies which are having very niche sort of an operation, specific subsegments, or might be catering to one particular segment of the economy or market, and then has to look more on the bottoms up basis, depending on to the companies' growth prospects as well as the return ratios. So then 251st, which is like anything below, you can say maybe in current context more like $3.5 billion below is what classified as the small cap. So in terms of maybe just to add here, how does, let's say, each of the market cap segment do differ in terms of from client's point of view, risk and return point of view, right? Generally large cap companies, if we look into last 1 or 2 decade data point or earnings as well, typically their earnings has to grow in line with maybe nominal GDP growth rate and basically normalized by maybe 11-12% sort of earnings CAGR. But then again, very steady, predictable sort of a maybe earnings. You can say that relatively volatility has to be low. Yes, sectoral dynamics will play their own part. And then comes the mid caps, which do offer relatively higher earnings potential, but at the same time comes with relatively higher sort of a volatility. And last is the small cap, which is like obviously relatively more volatile. by nature, but then also do offer the higher sort of earnings growth potential over medium term.
Actually, you answered my second question as well,
Hmm.
because I was going to ask about the earnings growth estimates that you
Okay.
uh, look at when you're looking at large, mid, and small cap.
Hmm.
But we have seen a tremendous rally in mid and small caps over the last one and a half year. They've given more than 60% returns in last 1 year, and you manage more than 70,000 crores in your mid cap scheme. So, how are you looking at the valuations in this space?
Hmm.
And one thing that we see is that people always try to chase returns.
Yeah.
When we see that the mid and small cap funds have given very good returns, they try to add allocation over there. So, do SIPs, STPs are a better option to allocate money in mid and small caps at this time?
Sure. So one thing you have to understand that given, let's say, I mean, India, first of all, overall good macros, and then more around government policy setup. I mean, lot many newer sort of business opportunities are also coming. Plus, at the same time, the delta change in earnings for maybe some of the mid and small cap companies, maybe because of incentives, PLI incentives, so many newer businesses are also sort of emerging. So, inherent earning growth potential to become very, very high. Just to give you certain data point, pre-COVID, last 10 year, fiscal year 9 to 19, mid cap earnings CAGR has been 8.5-9%. From 19 to 24, it has jumped to almost 20% plus sort of a CAGR. So, and now even, I mean, this sort of a growth potential still remains. But you are absolutely right that current valuations are factoring in not even 1 year forward earning, but even next 2 years sort of earnings in many of the cases. So to that
Correct.
extent, yes, I mean, I think valuations versus historical average are like 40-50% higher. And versus large cap also the valuation premium is again 40-50% sort of a valuation premium,
Correct.
which historically has been lower. I mean, right? So some of those higher growth potential are sort of built in into the current. I mean, current sort of higher earning potential is being built into the current valuation. So to that extent, I think from here on, I mean, return expectation has to be toned down because last
Correct.
4-5 years has been exceedingly well, and while large cap returns has matched the earning growth last 5 years, mid and small cap returns has been far higher than the earnings growth. So the
Correct.
element of re-rating has been very significant. So
Correct.
from here on, scope for re-rating looks low, but yeah, I mean, earnings growth might still be good. So to that extent, I think, I mean, it might still do well, but then return expectations has to be toned down.
Correct. Correct. You know, we always say that whatever rally that you've seen over the last 1 and 3 years, you should have reasonable expectations going forward.
Yeah, absolutely. Makes sense.
Correct. And just on the index side, mid cap index, as you said, that it's made of 150 stocks,
Yeah.
which are basically 101 to 250 companies, listed companies in terms of market cap. So, how is this index constituted in terms of sectors if we bifurcate it? And which are the key sectors where you are currently overweight in your fund and key sectors where you are currently underweight?
Sure. So see, one good advantage of mid-cap index is that it's relatively well diversified from the sectoral coverage point of view, unlike, let's say, large cap indices, which is a bit more financials heavy, right? I mean, here it is very well diversified across financials, capital goods, pharmaceutical, then I mean, then you look into, let's say, even the real estate, I mean, side of it, and auto ancillary. So it is a very well diversified index with, let's say, maybe financials weightages are, let's say, maybe around 13 odd percent. In capital goods, industrial weightages are at around 8 to 9 odd percent. Pharmaceutical is again 8 to 9 odd percent. So there is a very well diversification, um, and then so it is a very good representation of the overall overall economy, right? I mean, in that sense that it do contribute very well diversified across different sectors. Uh, at current juncture, I mean, where we do find more value is that I mean, sectors like, let's say, banking, financial sector, pharmaceutical, healthcare. consumer discretionary, metals companies, and then maybe within infrastructure bucket you can say maybe logistics and all. I mean, I think some of these sectors are looking relatively more sort of an exciting from where the valuation are, and second, what is the ask rate, right? I mean, in terms of the future earnings growth potential, because see, in current market, I mean, there has been a pretty good earnings expectations being built into it. So at this juncture, when valuations are full, you have to really bet on some of the sectors where either valuations is in your favor or second, future earnings are relatively more sort of realistic.
Correct.
You cannot really, ride at current juncture. I mean, on the sectors where earnings are also full and valuations are also full.
Correct. No, I always say that now it's the time for the stock figures market.
Yeah.
Earlier, 1 year back, you could have picked anything and that would have gone up. But now it's very prudent to give money uh, to a team or to a fund manager who is actively managing the portfolio. And as a wealth manager, we always look at the time horizon when recommending portfolios to our clients. So, what is the time horizon in your portfolio when you're picking any stock? And what is the typical churn rate of your portfolio?
So typically, see, when we pick up any company, I mean, we do. I mean, see, I mean, until and unless, I mean, we can permanently own also the company. I mean, until and unless, see, companies delivering on our sort of an expectation and valuations are not out of whack.
Correct.
Right? Price value gap equation still remains, right? So to that extent, I mean, we can keep on owning that company. But yeah, typically when we try to pick and choose businesses, it's like, I mean, at least 3 years sort of a time horizon, and initial criteria is that 3 year 50% upside. And then because see, I mean, it is very difficult for a company to judge on, let's say, 3-6 month basis, because when you try to pick and choose company, I mean, there might always be the case that during short period of time, because of so many things around, I mean, there might always be earnings downgrade or upgrade and all that. But then try to give the realistic sort of a time horizon, and then try to keep on tracking the company on a let's say quarterly basis or maybe regular basis. So typically 3 years is a good sort of a time horizon. Um, Higher is better, and the same holds true in case of the investors as well, because uh, because the, because then, I mean, across the cycle it gets sort of average out, and then the true potential really gets reflected. So I mean, that is how it is when it comes to the churning the portfolio. Typically, relatively, we do like to hold companies for the longer sort of a time horizon. So maybe typical portfolio turnover ratio in our mandates would be maybe 35-40% on the higher side. Yeah.
Correct. Correct. And do you think that mutual fund is a very tax efficient mode of investing? Because if I'm suppose owning the similar portfolio in direct stocks directly in my demat account, and I'm churning 40% of my portfolio every time, as an individual investor, I will have to either I'll get subjected to STCG, short-term capital gains tax, or long-term capital gains tax. But since mutual funds are a pass-through structure, whatever churning that you do in your portfolio, investors would get taxed only when they redeem. So I am not getting my reinvestment cost does not go down. So do you think it's a very it's the most tax efficient structure at this point in time in Indian market?
No, you are absolutely right. I mean, very valid point here that because of this pass-through sort of a structure, I mean, typically for us, we can, let's say, I mean, buy and sell, and then without impacting the basically taxation at the clients. And so to that extent, yes, I mean, I think it is an advantage.
Correct.
Sure.
And I was talking to someone in US. In US, mutual funds have to pay tax on their internal journey.
Oh, is it? Okay. Yeah.
And but India is such a tax efficient structure.
Yeah, absolutely, yes.
And we hear a lot about liquidity in market. It's very high. So, for the benefit of audience, just wanted you to add your words on what role does liquidity play in market,
Yeah, no,
and who have been the major suppliers of liquidity in the recent times.
yeah, yeah. So see, stock price is a function of demand and supply, right? So if there is more money into the market, which means more demand, right? While obviously supply also do catch up. We have been seeing these times that, I think promoters are selling at the highest pace to that extent. I think by YTD itself, the selling is like 80,000 crore plus. But having said that, because of more demand due to more sort of inflows to the equity market, and I think I'm sure you are aware that the way liquidity has gone up, right, pre-COVID and now. It is at a different trajectory. Almost 4x is the SIP book, right, pre-COVID and now, from 6,000 to almost 24,000. That is one part of it, and besides that, if you look into almost $30 billion worth of an inflow, and that is in a way non-discretionary inflow by the domestics. That is pretty much there into the market. That is by way of SIP, plus the proportion of money going from EPFO into the market, then insurance to the market and all. So all of these are non-discretionary flow, which means compulsorily, has to come on that particular date or maybe particular day, right? So to that extent, I think it is a very, very sizable number, and that is what is helping helping also to the market, because despite of FI ownership into the Indian market coming down pre-COVID and now, markets has done reasonably well. Yes, earnings has supported, but clearly this bout of liquidity has also played its own part.
Correct. No, yeah, domestic investors have supported the markets relatively well, and we have seen very good macro parameters for our country. How are you looking at the current interest rate scenario, and how does global market affect the interest rates in India? We have today seen
Yeah.
the rate cut by Fed, but how does that global factor
Sure.
impact Indian market?
Yeah. No, so first of all, before coming on to rate cut, let's look into the rate hike cycle, which has started, let's say, after COVID. For us, it has been relatively benign, right? From 4.5 repo rate going to 6.5. It is like
Correct.
200 bips high. While world over, it has been a different trajectory, right? From 0.25 to zero point 0.5 range as going to 5.25 to 5.5, almost 500 bips sort of a jump in a very short span of time has been a significantly high sort of an interest rate environment. So, so to that extent, yes, and plus also we have to look into the way economies have leveraged over time, right? Keeping interest rates high for a sustained period of time is again translated into more sort of liabilities getting created by way of higher finance costs, further increasing the deficit and all. So that is a very vicious cycle, right? So to that extent, now if inflation is cooling off as per them, there's a glide path of inflation coming down to 2%. There has been this rate cut yesterday, you saw by US Fed. But having said that, whether India will necessarily follow, not follow, needs to be seen. But our call is more like maybe a bit of a shallow rate cut. Maybe by the end of this, end of this fiscal year, it might not necessarily be 1:1 sort of a correlation that what US Fed is going to do versus the other. Dynamics are different, and at the end of the day, we also have to look into the real rate differential uh, uh, for India versus the US, right? To make it more attractive from the flows as well as currency standpoint.
Right. And I have a question on India's consumption story. You manage more than 4,000 crores in your consumption fund. How are you looking at this domestic consumption story uh, for the next 5 years and 10 years? And what are the type of stocks that come under the consumption fee?
No, so no, it is. I will say one of the most exciting. Sort of a themes when it comes to play to the India market, because India has got the typical very strong demographic advantage in terms of very young nation, very young population. and very very long runway for growth, because in most of the categories we are highly underpenetrated, as well as enough scope of premiumization as per capita income goes up. And if you try to look into world over, currently we are like $2,500 per capita world over. You look into, once you reach certain milestone, $3,000, $4,000 per capita income, there is a significant amount of spend goes more so on the discretionary side of it. So, and which is a non-linear curve, right? I mean, once I mean, so to that extent, I think this is one theme where, and this is a very broad theme, and that is what we are playing through our fund as well, which which includes, I mean, all your consumer staples, traditional consumer staple, but more consumer discretionary, which includes a lot of retail companies, either into apparel, fashion. I mean, could be into, let's say, beauty side of it, or maybe maybe and footwear, and so many segments within the retail side of it. Then it also comes onto the onto the consumer durable side of it, which is white goods, brown goods, and all. Then it comes onto the entire building material, side of it as well. So we are trying to play relatively broader theme, which is like, I mean, what you and me as a consumer can spend on which all items, apart from your, let's say, savings. Side. And even savings also we are trying to play it through maybe AMCs, or maybe some of those names into this thing, including hospitals, diagnostic. I mean, I think some of those are also part of the universe.
Right. And on this theme, consumption theme, how do economic downturns or recessions impact consumable companies differently than other sectors?
Sure. So see, I mean, if you look into historically, I mean, typically, because see, in India, GDP is 60% is domestic consumption in that sense. Typically, consumption do follow pattern in line with the GDP growth. So multiplier to GDP might be one x historically, right? And plus, obviously, you add inflation, then in nominal sense, maybe 10-11% sort of a growth is on an average given. So it is very very predictable. No, in that sense, right? I mean, different segments might have their own sort of a driver. Some might grow higher, some might be lower. But on an average, and that is how, if you look into last one decade, typically top 15, uh, 20 consumption companies' average earnings growth has outperformed 6 out of 10 times the Nifty 50 earning growth. I mean, in last one decade. So I think there is some sort of a predictability, stability, and that's why these companies also do trade at a much higher valuation multiple. But this versus, if you try to compare with maybe some of the other segment of the market and all, clearly multiplier there is the beta is very very high, either on the positive as well as negative side, right? So to that extent, their earnings volatility typically are very much in sync with economic activities, and basically investment into the economy. Consumption also do get impacted, but not to that extent as other part of the market as such. Correct. So, like you, typical example is, let's say, post COVID, we have seen that rural consumer spending has been soft. Why it has been so? Because clearly, I mean, I think post COVID, very high inflation, earnings got impacted at the mass end and all. So which has clearly led to decline into the disposable income, impacting the volume growth in many of the categories for last 2 years.
Very true. And in the consumption sector. It's basically day-to-day consumption requirements, needs of the daily investor. Are there any technological innovations driving growth in this industry?
Yeah,
and how has the rise of e-commerce changed this industry?
No, you're absolutely right. I mean, you look into, I mean, now let's say with smartphone everywhere and all, right? Dissemination of information is very very quick, right? And even to keep So see, one now with this sort of a, let's say, way of digital marketing and all, first, I mean, experimentation has gone up with the newer products and all, and even consumers are also now with their site is they are more experimentative. If given, let's say, wider options are available, so that's why if you look into even for newer companies to come in into any particular segment and all, cost to market a new product is not that high. They can always test market, giving some sort of a digital advertisement and all, and then try to test it, and then if it is successful, then can be launched at a mass level. So time to market, cost to market, those things has relatively come down with more wider option and all. I mean, I think even people are willing to experiment more. So that is one thing. Second, when it comes to the channel shift, I mean, I think that is another very big sort of thing, right? I mean, with e-commerce and all, you look into currently in India, almost e-commerce spending is around 8% odd. That is at an overall consumption level. So almost we are spending around $70 billion online. So which is around 8% odd. But in certain categories, if you look into, the penetration is very high. I mean, much higher than I mean, let's say 8%. Typical example is, let's say, electronics, mobile phones, and all that. Right. So that is one. That is the e-commerce part of it. Second is the modern trade part of it. Right. The formalized segment of the market and all. So they are also now um, with with with, let's say, bigger players increasing their reach and all. I mean, I think much more market is shifting in favor of there as well. So I think some of these channel shifts and all do have their own sort of a dynamics, do have their own I mean, on sort of equation and impact onto the manufacturers. So yeah, I mean, I think all of these are like, I mean, very evolving. I mean, sort of a scenarios. Yeah.
Definitely, and I think that even the consumer behavior
Yeah.
is changing a lot, particularly in the last mile delivery. People trying to order groceries now with Zepto and Swiggy, Instamart, you can get the groceries within 6 minutes. And even our attitude or the behavior has also changed. Just order it and then it gets delivered within 6 to 7 minutes at my house.
No, you are absolutely right. I mean, this entire quick commerce segment within a span of 2-3 years, it has become now $2.5-3 billion GML. So it is a very sizable in that context.
Ankit, thank you so much for your great insights on the market and about your funds. Just last question from our end. Can you throw some light on your fund house, mere asset mutual fund, and some of the best practices that you deploy at your fund house?
Sure. So Mere is a South Korea based company. Started there in 1997. In India, we started just before global financial crisis in 2007. We started. So almost now 17-18 years of journey. Currently, we are like seventh largest equity mutual fund house. I mean, being obviously, I mean, basically MNC company, and otherwise also, I mean, there are a very, I mean, strong, I mean, sort of a practices being followed. I mean, which are also being followed I mean, world over across the globe. Be when it comes to, let's say, this entire risk, I mean, risk management process. So I think there's significant emphasis is being given across, and then I mean, which to include this entire portfolio liquidity and so many other sort of filters, right? Besides that, I mean, I think we on our own also do follow lot of gatekeeper, I mean, sort of a processes, which again, I mean, time and again do helps us, I mean, sort of manage this entire process very efficiently at the same time, basically to be in compliance, I mean, compliance with the law. Yeah.
Thank you so much, Ankit, for your wonderful insights. And it was a great session.
Yeah.
And we look forward to do more such sessions with you and your fund house.
Sure. No, thanks.
Thank you so much.
Thank you.
Thank you.